Ladies and gentlemen, it is happening again. Banks are losing billions and billions of dollars on this one asset class, and this could be 2008 all over again. So what asset class are they losing billions on? Why is this important for the financial system, and what could this lead to in the future, and how can we prepare for this or take advantage of this situation? Well, that's exactly what we're going to get into in today's video. So let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Well, look at this, everyone. Mortgage market upheaval spurs 16 billion in paper losses for banks. Unrealized losses will hinder banks' efforts to boost capital, and buybacks will probably remain on pause amid capital headwinds. So what is this one asset class, everyone? That's right, that is mortgage-backed securities. And like we've seen here, so far the banks have taken a hit of $17 billion, but these losses are only about to get much, much worse as we start to see the housing market begin to crash. And people, I'll get into in a moment a bit more about these mortgage-backed securities crashing, but you need to understand what's happening in the housing market, which is going to be more pain for these mortgage-backed securities, which is going to equal bigger and bigger losses for the banks, who are going to be in big trouble, and they're not going to be able to buy back their stocks like they could in 2008 and 2009 with interest rates going higher and higher, and they're going to have more capital reserves to offset these losses. Because look at this, everyone. Okay, this is the first reason why these mortgage-backed security assets are going to keep falling, and that is because the housing market is falling. Listen to this, everyone. Home sales fell for the 9th straight month in October as higher mortgage rates scared off potential buyers. Now, with these mortgage-backed securities like bonds, when interest rates go up, the assets fall in price because people wouldn't want to buy these mortgage-backed securities that are paying low interest when they can go to other assets with high yields, for example, 2-year bonds that are paying yields over 4% and have a lot less risk. Sales of previously owned homes dropped 5.9% from September to October, according to a National Association of Realtors. And this is the slowest pace since December 2011. So that's the first piece of the puzzle, everyone. Home sales are falling. And it's not just previously owned homes that are falling as well. Also, the construction industry is facing big problems. Look at this. US housing starts drop with pullback in single home family projects. Home building declined 4.2% last month to 1.43 million pace. Single family starts permits fell to its lowest since May 2020. So demand is weakening, but what has been their excuse on why the housing market won't crash? Well, it's all been about inventory. They've been saying inventory is so low, so house prices won't start to fall significantly. Well, people, that is all now starting to reverse. Look at this data. Okay, this is the chart of housing inventory and active listing count in the United States. Now we can see here in 2021 and also early 2020, inventory did absolutely collapse and it fell to lowest levels we've seen in years. But the trend is your friend, everyone, and we can see this trend is reversing. And now inventory has gone from February 2022 of 347,000 units or active listings, and it's now nearly doubled to 753,000. But that's not all. Now, something much more alarming is monthly supply of new houses in the United States. We can see here in January 2009, it hit a peak of 12.2 months worth of supply. Now we can see here again in August 2020, it absolutely collapsed to only 3.3 months of supply. But now it has surged to over 10%, and then it dropped a little bit, but now it's surged back up again to 9.2 months of supply on the housing market for new homes. Now, normally 6 months of supply would be a balanced market, but we're having over 9 months worth of supply. So that means home prices for new homes are going to start falling lower and lower. Also, some very bad news for the housing market is mortgage rates. Mortgage rates have surged from 5.4% all the way up to 7.2%. They have dropped off a fair bit recently, but I expect as the Federal Reserve keeps on lifting interest rates, we're going to see mortgage rates, I think, will hit in the 8% range. So a quick equation here, people. Demand is falling, inventory is rising, and cost for debt, cost for credit is absolutely skyrocketing. What do you think this is going to lead to? It doesn't take an economist, it doesn't take a financial guru to figure out that this is meaning house prices are going to start to fall and fall significantly, and even the Federal Reserve is now starting to admit it. Look at this, everyone. Federal Reserve thinks house prices could plunge 20%. Now, I think that's actually being conservative because we've had mortgage rates go from around a low of 2.75% to more than 7%. So that's a difference of about 4.5%. Now, what happens with people when they go to apply for a mortgage, normally every time mortgage rates go up 1%, they lose about 10% of their purchasing power or borrowing power. So what we're seeing in the housing market is people lose anywhere between 30 to 40% of their borrowing power, and we're going to see supply start coming onto the market again, and that means prices are going to simply have to fall or correct to become back in line with reality. And what this is going to mean for the banks is these mortgage-backed securities, as house prices fall, as people become delinquent, as people start missing payments, and people start actually defaulting on these loans, these mortgage-backed security assets on the bank's balance sheets are going to crash, and this is going to mean big, big losses for the banks. So let's head back to that report from Bloomberg to see what's really happening under the hood of these banks' balance sheets, because they've been trying to hide it. They've been trying to turn it onto other balance sheets so the media wouldn't see what's really going on. At Wells Fargo, it was an additional $2.4 billion in unrealized losses on mortgage-backed securities and other bonds that weighed on shareholders' equity in the third quarter. Wells Fargo's three biggest rivals took a similar hit. On mortgage-backed securities alone, the four banks' unrealized losses have climbed to $17 billion based on company filings. So while banks' earnings reports have looked pretty good because of high interest rates, they've had high revenue and better profit margins. But what they have been hiding in these earnings report is these huge losses on their balance sheet, which what they're now doing is they're taking these mortgage-backed securities and they're putting it on their balance sheet called hold to maturity. So these are just paper losses and they're not actually showing up on real losses on their balance sheet. So it's kind of making it look like their profit is higher when they're doing these earnings report. But some banks are going to be forced to sell these mortgage-backed securities at a loss, and it is going to mean less bottom line for the big banks. When it comes to managing capital, we should be extremely conscious of what risks are that are around us, citing swings in the value of banks' investments portfolio, as well as geopolitical risks. Those are all the reasons, given where we sit today, to be more conservative on capital rather than less conservative. So what we have here is Wells Fargo CEO warning that these asset prices are going to fall more and they need to start creating their rainy day fund. They're going to have to start preserving more capital, and this could lead to a potential credit freeze or a lot less credit being issued in the market, which is going to lead to much more pain coming for all these people that are desperately trying to rely on their credit cards to keep up with the rising cost of living. And this is how the banks are hiding these losses with their creative accounting. The unrealized losses don't appear on the firm's income statement, but under accounting rules, they still end up hitting the bank's balance sheets, affecting so-called accumulated other comprehensive income, or AOCI. There, the country's four largest banks, JP Morgan Chase & Co., Citigroup Inc., Bank of America, and Wells Fargo reported a $16 billion drop in AOCI for the third quarter, to negative $102 billion. Because swings in the AOCI affect shareholder equity, the drop in AOCI has weighed on key capital ratios. And you can look at this chart here to see how much the banks are losing. You can see here Bank of America down $21 billion. We can see here Citigroup down $48 billion. JP Morgan down $19 billion. And Wells Fargo lost $14 billion. And another chart here run banks mortgage misery. Mortgage bond losses has swelled in available for sale portfolios. And we can see here who's had the biggest losses are JP Morgan, $7.4 billion, and followed by Wells Fargo of $6 billion. So everyone, I know what you're thinking, well, okay, what does all this economic and finance jargon mean for you in simple terms? What this means, everyone, these mortgage-backed securities, now that the Federal Reserve is not propping up this market, now that they're selling these assets, these are going to crash. A lot of these banks are holding these assets on their balance sheet, so they're going to lose billions and billions of dollars. And also when the housing market begins to crash, because we're only starting to see the early signs, but remember, this can take about 2 years to play out. Like what happened when the market peaked in 2007, we didn't see the market actually bottom till 2010. So these things are going to take time to play out, but they will play out. And there's going to be big, big trouble for the banks. So you're definitely going to want to prepare for this by hoarding cash on the sidelines, waiting for some opportunities coming ahead, because even though people think the market may have bottomed, I don't think that's happened at all. I think these bank stocks could crash once we start to see these realized assets on their balance sheets. And if you're thinking about buying a home, I would not be buying now at all. I think prices are going to start falling early 2023, and we're going to start to see these price declines really accelerate mid 2023 when we start to get the year-over-year comparisons to show that prices are falling. But everyone, what do you think about all of this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.